Breaking news from Washington. The Federal Reserve just made their most significant move in nearly a year, and it's about to put real money back into American wallets. For the first time since December, the Fed cut interest rates, but the story behind this decision reveals growing fears about America's economic future. This isn't just another policy adjustment. This is the Fed hitting the panic button on unemployment. At exactly 2 p.m. Eastern today, Federal Reserve Chairman Jerome Powell announced a quarter-point cut to the federal funds rate, bringing it down to a range of 4.75% to 5.00%. This marks the first rate reduction in 9 months and signals a dramatic shift in the Fed's strategy. But here's what Powell didn't say in his prepared remarks. This cut wasn't about celebrating economic strength. Powell himself called it a risk management cut. Fed speak for, "We're worried about what's coming next." The driving force behind this decision? A deteriorating job market that has Fed officials increasingly concerned about rising unemployment. Powell warned that in today's weak hiring environment, displaced workers are struggling to find new opportunities quickly. The unemployment rate has already climbed to 4.3%, the highest since 2021. And now let's break down what this means for your money, because the impacts are immediate and significant. First, mortgage rates. If you're in the market for a home or considering a refinance, this is your moment. 30-year fixed rates are already beginning to tick downward from their recent highs near 7%. Industry experts predict rates could drop to the mid-6% range by year-end. Credit card holders will see relief too. Variable rate cards tied to the prime rate will drop by exactly 0.25%, potentially saving families hundreds in interest payments annually. If you're carrying a $10,000 balance, that's about $25 less per year in interest. But here's the trade-off. Your savings accounts and CDs are about to see their yield shrink. The Fed's projections suggest 2 more cuts could be coming before year-end, which means savers will see further declines in their returns. Those 5% CD rates? They're disappearing fast. Wall Street's reaction was surprisingly muted and tells us everything about market expectations. The S&P 500 actually closed down 0.1%, while the Nasdaq fell 0.3. Only the Dow celebrated, up 0.5%. Why the lukewarm response? Traders had already priced in this cut. What they're watching for are future moves, and here's where it gets politically interesting. The Fed's updated projections show most officials expect 2 additional quarter-point cuts in 2025. However, there was one notable outlier, a single, showing expectations for much more aggressive cuts. That belongs to Stephen Miron, President Trump's economic advisor, who was just sworn in as the newest Fed board member yesterday and cast the lone dissenting vote today, favoring a larger half-point cut. This sets up a fascinating power struggle within the Fed, with Trump's allies pushing for faster, deeper cuts while traditional Fed officials remain cautious. Here's your bottom line. If you've been waiting to make major purchases, refinance debt, or lock in lower rates, the Fed just opened a window of opportunity that may stay open through the end of the year. But remember, rate cuts typically happen because the economy needs life support, not because everything is perfect. Keep watching employment data over the coming months, because that's what really has the Fed worried. The next Fed meeting is October 28th, and with Trump's influence growing stronger, expect fireworks. Subscribe and hit notifications to stay ahead of every move that affects your money.